Y'all ready for this? Let's go.
Welcome back to the Ben James Smith podcast. Today's episode is slightly different. We're not going to talk about markets, structures, or capital flows directly. We're going to talk about something more personal, because before most investors make their first allocation into a new opportunity, they go through a decision process, and interestingly, that process is often where mistakes are made. Not because people lack intelligence, but because they're asking the wrong questions. So today I want to walk through some of the most common things investors get wrong, particularly before their first allocation, and how that thinking evolves over time. Mistake number 1. Focusing too much on return. The first mistake is the most obvious. Over-focusing on return. What's the ROI? What's the upside? What's the best case scenario? These are natural questions, but they're not the most important ones, because return is a projection, and projections are built on assumptions. Sophisticated investors don't start with return, they start with risk. Specifically, what would cause this not to work? Because avoiding loss is more powerful than chasing gain. Mistake number 2, treating each investment in isolation. The second mistake is evaluating investments as one-off decisions, looking at each opportunity separately, trying to decide, is this a good deal? But experienced investors think differently. They look at, how does this fit into a system? Because long-term performance doesn't come from one decision, it comes from a series of decisions made consistently. So instead of asking, is this good? They ask, is this repeatable? Mistake number 3, underestimating structure. Many investors focus on the asset, location, design, numbers, but overlook the structure behind it. Who controls the capital? Who makes the decisions? What happens under pressure? Because again, assets don't determine outcomes on their own. Structure determines how assets are managed, and that's what ultimately drives results. Mistake number 4, misunderstanding risk. Another common mistake is misunderstanding what risk actually is. Risk is often defined as, will I lose money? But in reality, risk is, will something happen that I didn't expect? Because unexpected events are what cause poor decisions, and poor decisions are what lead to loss. So experienced investors don't try to eliminate risk, they try to eliminate surprise. Mistake number 5, waiting for certainty. This is probably the most common one. Waiting for the perfect moment, when everything feels clear, when all risks are removed, when the decision feels obvious. The problem is, that moment doesn't exist, because if something is completely certain, it's already priced. The best opportunities often exist in periods of partial uncertainty, where downside is understood, but confidence hasn't fully returned. Mistake number 6, confusing activity with progress. Some investors feel like they need to act quickly, evaluate multiple deals, move fast, stay busy, but activity is not progress. Progress is clarity, and clarity often comes from doing less, but understanding more. So how do seasoned investors make the shift? Over time, investors change how they think. They move from return to risk, from deals to systems, from activity to discipline, from certainty to understanding. And once that shift happens, decisions become simpler, not easier, but clearer. So if you're evaluating an opportunity or thinking about making your first allocation into something new, it's worth stepping back, not to look harder at the numbers, but to look differently at the structure. Because ultimately, investing is not about predicting the future. It's about choosing environments where good decisions are made consistently. Thanks for listening. And remember, the best investors don't make better decisions. They build systems that make decisions better. I'll see you in the next episode.